It was a somewhat quiet day on Wall Street today, although we did have one burst of energy to the upside and the market was up about 1% at its highs. And then we did have a burst of energy to the downside where we were down 1% at its lows. But then we kind of settled in the middle of those ranges by the time it was all said and done. So in the end, not a whole lot to get too worked up about as we head into tomorrow, where there could be a bit more volatility. Remember, tomorrow is going to be options expiration for the month of October. We're also hearing after hours tonight, one major social media company is just tanking after hours, and so the communication sector is likely to start tomorrow morning off on the wrong foot. So we'll talk about all of that in tonight's video. We'll have some conversations about bonds and interest rates in tonight's video. We'll talk about the postures of the various sectors out there. And then I'm going to get into a trade application example where I do a rare sold put trade on an ETF, not an individual stock, that has just its fourth oversold cluster signal on a weekly candle chart over the past decade. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's October 20th, 2022. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, and then go down below into the description area so that way you can be signed up for our email distribution list as well. Also, thanks to those of you who had to bear with me on Tuesday when I did the video. Little did I know that YouTube was going to be suffering a processing outage for about 5 or 6 hours. So I was just waiting to post my video hour after hour, hitting refresh. And finally, before I went to bed, we were able to get that accomplished. But hopefully no technical difficulties with YouTube here tonight. Also, we're heavy users of Twitter. If you're not doing so already, I would encourage you to follow me. My handle is @BrandonVanZee, and we really appreciate those of you that click like and retweet with these Market Outlook related posts. And then last but not least, we do have a presence on Facebook. Feel free to join our group at that web address you see in the logo in front of you. All right, let's jump into today's trade activity. And as you can see, it was more of a down day here today. Sometimes I want to say, you know, the old phrase is another day, another dollar. It kind of feels like the more proper phrase these days would be another day, another dollar lost, because as I was mentioning to you guys last week, we've actually had more down days this year than up days, which is incredibly rare for the stock market. But here we go. Once again, more of the same. You can see who today's big culprit was. Nice thing about this heat map here in front of us is it will show us the most influential companies upon the price of the S&P 500 itself, which of course is a market cap weighted index. And so big culprit today, Tesla, down over 6% upon its earnings announcement. I heard that Elon Musk proclaimed that Tesla would one day be bigger than Saudi Aramco and Apple combined. However, that didn't really seem to soothe investors here today. They weren't having it. So that one did cause some pressure there. And I imagine we'll probably see an impact on the consumer discretionary space here when we get to the sector analysis a little bit later as a result of Tesla having such a big allocation to that particular sector ETF. You'll also notice some other big losers today. How about Danaher, down about 6% today as well. Union Pacific was down almost 7% today. That's a company I'm quite fond of. One of the biggest railroad companies here in the United States. Tremendous moat or economic competitive advantages, and it's getting closer to a 3% dividend yield once again. For those of you that have been students of mine over the years, some of you may recall that back when I was with TD Ameritrade, we bought UNP in, I think it was January 2016, as it dipped into the territory that would allow it for a 3% dividend yield. So for that particular company, a 3% yield is somewhat rare. And we're getting pretty close to that once again after selling off 7% today. So if you're looking for some exposure to the transportation stocks and you're looking for a company with a pretty good track record of dividend growth, then Union Pacific might be one you keep on your radar. We also saw some selling here in the two home improvement store companies. Home Depot was down 2%, Lowe's was down 3% here today. They're part of that whole housing complex that just continues to struggle. Right now we have a short selling position in my factor-based swing trading class on one of the home building stocks, and it's just remarkable to see them fall as consistently as they have this year. And of course, it's basically an inverse chart to whatever's happening with interest rates. We'll get to that a little bit later when we get to our asset class 12 grid, but as most of you know, a lot of the market activity these days is being driven by interest rates, and Home Depot and Lowe's would be kind of case in point there, where they tend to struggle when interest rates go up, and then vice versa. Naturally a lot less home building is going to be going on here in all likelihood in coming months and quarters, perhaps years, if interest rates stay up at these levels. Mortgage rates are around 7% or whatever they are these days, and home affordability is nowhere near what it would have been just a year ago as a direct result of the interest payments on mortgages. And so I have a feeling that the home building industry is going to come to a screeching halt if interest rates do stay high like a lot of people expect. So brace yourself there. Remember, there's a lot of different indirect companies that aren't necessarily home builders themselves, but maybe sell furniture into the home or appliances or different things like that that are going to struggle. In fact, tonight after the bell, I saw that Whirlpool was down quite a bit as a company that, of course, would typically benefit when you're buying new homes and filling them up with washers and dryers and things like that. So anyway, tough times there with anything home related these days because of surging mortgage rates. We see a lot of the financials down today as well. In fact, it's pretty rare to see so many financials. Like if I were to right click, dive directly into the financials alone, you had the NASDAQ, which was up. Now remember, this is not the NASDAQ composite. This is the actual exchange itself, the profit-making entity that runs the NASDAQ exchange. So this does not mean that the NASDAQ composite, the index of tech stocks, was up today. That was exactly the opposite. They were down quite a bit, of course, because of Tesla and others. But the exchange itself managed to pull off a win of about 1.5%. And then we see State Street that was up just barely here today, up 0.45%. But otherwise, looks like pretty much all the rest of them were in the red. Worst performer, by the way, was Allstate. Like I was mentioning to my premium class earlier today, I was a little surprised to see that because many of you know I do the 9 at 9 graphic every morning to let you guys know which stocks are up the most and which stocks are down the most in the pre-market session. Remember, that is something that's available for free for all of you. So even if you're not one of our premium members, you can still access that part of our website, or just follow me on Twitter where I tweet it out every morning as well. But it was a little surprising to me today to wake up to see Allstate was the worst performer in the market. I'm thinking to myself, boy, when was the last time I saw that? Because typically you think of Allstate as a very, very boring insurance company. But of course, a little bit less boring when you've just gone through a major hurricane or storm where you're on the hook for paying a lot of claims. And so that caught up with them in a big way here today. And that difficult sentiment, carried through to the other insurance companies out there like Travelers and Chubb and Progressive and others. So anyway, that was a little bit of a surprise because usually insurance companies quite boring. See what else we can glean. Looks like we had most of the industrials companies except for the defense companies in the red once again. And how many times have I said that here recently? I kind of feel like a broken record. But here we are once again with Lockheed Martin up today. We had L3 Harris up today. We had Northrop Grumman up today and Boeing up today. Remember, Boeing is kind of a split company. They have about half of their business coming from commercial and then the other side on defense. So those four managed to escape the selling that occurred in the rest of the more cyclical area of the industrials. You also saw that consumer staples were down today. Remember, sometimes consumer staples can sneak in a victory or a win here or there, even when the rest of the market is on the losing side of the equation because they're considered more defensive, but today was not their day for whatever reason. In terms of which areas had a little bit more bullishness to them, I would point out that for once, AT&T and Verizon were up. Boy, they have had a really, really difficult go of things here, not just this year, but in recent years in general. But today, I guess the sun was shining upon them. We also saw some other media properties that managed to close a little bit higher. Comcast was up just a little bit. Activision Blizzard, which of course is in talks with Microsoft to be bought out, was up today. We got Warner Brothers up just a touch here today as well. So T-Mobile was up just a little bit as well. So that area seemed to work out a little bit better than average. We had a niche of software that did okay. We had Oracle, actually a pretty nice day there, up 4.4%. Salesforce.com up 2.5%. Remember I mentioned that one on Tuesday. There was a hedge fund, I think it was Starboard Value, that is taking an interest in them. And then Adobe was up today, which, as you guys know, makes me happy, considering we just did a bullish trade on that 1 week ago. And so far, so good on it. And again, I'll reiterate what I said on Tuesday, which is this is not the environment where I want to be counting my chickens before they're hatched. And so I'm going to tread cautiously around that and be thankful. We've got a rare winning bullish trade on our hands there for the trade application. But you just don't know how that's going to unfold. For all I know, we could crash tomorrow and we could be stopped out as soon as that. So we'll see where it takes us. But so far, so good, having a little bit more bullishness in some of those software names there. Even some of the semiconductor names kind of bounce back a little bit today. NVIDIA, Texas Instruments, AMD, MU, unfortunately, right? I do have a bearish trade on that one, so that one I'd kind of want to go the opposite direction, but it is what it is. And then AMAT and Lam Research, KLA 10 Core, they were all up. Another stock that was a little bit of a surprise today. Some of you saw me joking around a little bit on Twitter about this one this afternoon, and it's IBM. It has been a stock that has tested the patience of a lot of dividend growth investors. If you're in that line of work or have that as a strategy that you implement, you'll know what I'm referring to, because IBM is a rare tech stock that is in the Dividend Aristocrat list, but has effectively gone nowhere for the last, 5-6 years or whatever it's been. So I was joking that, I can't let myself get excited about their earnings announcement here today because they were up 5% and apparently had good earnings. But we've seen this we've seen this story play out before, and more times than not, it ends up with eventual disappointment. So I will, curb my enthusiasm a little bit on that. But nonetheless, give them their due. They won the day, and we're one of the best performers in the market here today. So that's your breakdown of the heat map. One other thing I should mention that we don't see here right now, but is worth mentioning here after hours, is Snap is getting snapped yet again. And like I was joking on Twitter, it feels like that joke just writes itself. In fact, I've tweeted it at least 3 different times. I tried to go back and check my history. But there's various pencil breaking gifs out there, and I always say Snap got snapped. And here we go once again. Snap is down another 25% today after announcing earnings in the after hours session. And that's not necessarily a great sign for risk appetite heading into tomorrow morning. While Snap is not nearly as influential as something like Meta/Facebook, it does have an impact. In fact, Meta is down after hours, not nearly as bad, but reacting to the Snap news, as is Alphabet, because it kind of is a temperature check as to what the advertising environment is like online right now. And apparently Snap just bombed their number, and so it doesn't really give us the impression that the online advertising budgets are going to be where a lot of folks want them to be as we head, closer and closer to a recession if we're not in one already. So brace yourself for tomorrow morning as the communication services sector is likely to be in the red. And remember, how many times have we said that this year? When we've looked at the sector selector tool on Tuesdays, more times than not, communication services has been in the bottom 3, and for much of the fall and summer they were dead last, and it just seems like they can't really get out of their own way right now, and Snap is not going to be helping their cause tomorrow morning. All right, let's go ahead and now take a look at the breadth numbers. And as you can see, 113 stocks out of the S&P 500 managed to close in the green here today. So that was good for about a 22% hit rate there. So again, we could probably see that with our own two eyes on the heat map a moment ago, but in case you didn't want to trust your eyes, that is the confirmation right there, where out of every 10 stocks in the market today, approximately only 2 of them were up and 8 of them were down. So a tough day for market participants all around. Let's go ahead and now get into our charting analysis. And we'll come on over here to chart 4B to get things rolling. This is our 4 grid, so that way we can look at the market forecast intermediate posture setting mechanism. A reminder to those of you who might be newer, the background colors of the chart will tell you what the posture is using that green intermediate line on the market forecast. So when the background color is pink, it means it's bearish. If it's green, it means it's bullish posture. So as you can see here, we are now back to 3 out of the 4 in the red or pink background colors, and that is the S&P 500 and the NASDAQ Composite and the Russell 2000. And as I told you 2 days ago, that is not a surprise to me because I don't trust this market. And so I was trying to encourage you guys on Tuesday when we did get those weekly bullish intermediate postures not to take them too seriously. Where I want to take them more seriously is when we can get confirmation from the 30-day moving average as well as the posture, and that we have not been able to do yet except in one case, and that one case is up here with the Dow Jones Industrial Average. Now even here, I'm still not like on board saying, hey, this Dow is going to really start rocking it to the upside now, and it could, right? But right now, notice that the moving average is still red. I'm sorry, it's yellow, meaning that it's going down in this case because price is above a falling moving average. So for those of you that are newer to looking at that line that has the different colors there, I always think of those plastic snakes. I grew up in South Dakota, and there's a place in western South Dakota called Reptile Gardens. I actually got a chance to take my 8-year-old there earlier this summer. And I remember when I was a kid and my parents took me there, and I bought this plastic snake that has these little segments in it that come in these different colors. And every time I look at this moving average, I think of that. But that's neither here nor there. Some of you might know what I'm talking about there. But how you read this moving average here is, first thing you want to know is it's a 30-day moving average, unless we tell you otherwise, right? You can kind of see up here above the charts, it says 3M, which stands for 3 months, and then 1D stands for 1 day. And so when you apply a 30-period moving average to a daily candle chart, it's a 30-day moving average. So that's the first thing you'll want to know. The color-coded mechanism that's working with the think scripts behind the scenes, and remember, you guys that are premium members of Market Scholars get access to all 50 plus of the charts that David and I use. And remember, if you're not a premium member yet, we'll likely be doing our Black Friday sale next month. So we'd love to have you join if it's in your budget. But anyway, the charts do change over time. Many of them are self-adjusting. We do have a few charts, like my dividend stair-step chart, that they get stale because I need to run calculations every single year on the dividend stair-step charts and then reload the script. So if you have a script of mine from years ago, that is no longer relevant for today's numbers because I use a rolling 10-year dividend yields calculation, and that means that every single year the dividend stair-step chart has different numbers that it is plotting. But these ones are mostly self-adjusting as time goes on, and the think script is instructed to paint the color of the moving average green when the price of the security is above the moving average and that moving average is rising. So like back here, notice it was green, and obviously the chart had candles above that clearly rising moving average. Let's talk about when it turns red now. So notice how that line turns red quite a bit as well. And what's happening there is price is below a falling moving average. So, obviously back here in like late September, it's pretty clear to see that that line is falling, and clearly the price of the security itself, these price candles, are below that falling line. The yellow part of that moving average is a little bit different and takes a little bit more understanding because it can be represented by two different things. And I kind of think of this as the way that I would think of a stoplight. Like green means go or good for bullish traders, whereas red would typically mean stop on a stoplight and would be bad for bullish traders. But yellow is kind of like yield, right? It's kind of wishy-washy. It's in the middle of those two. And that kind of serves a function here with understanding how this works as well. Because when the moving average is rising, like it was back here, and then price falls below it, price would be below a rising moving average. That would be a yellow part of the moving average. There's a sign of conflict there you could think of. Moving average is telling you that it's going up. Price is telling you that it's going down. There's a conflict, so it's painted in yellow for caution. And then the opposite can also happen, like over here, where the moving average itself is going down and price is now above it. It will also be yellow. So those two things tend to happen at extreme levels and can sometimes be transition areas as well. They don't have to be, and I'm a little bit cautious around that right now because it's nerve-wracking out there in the markets, and I'm just not sure how much I can trust it moving forward. But you will see that occasionally, right? If there ever is some sort of a legitimate trend-changing reversal, it's oftentimes going to start with a yellow part of the moving average because it's basically saying that the lag of the moving average itself is still going in the prior direction, whereas price is breaking out above it, and eventually, if it stays above it, it will start pulling that moving average up, in which case that moving average would then turn green again, and you start that cycle over. So the Dow Jones Industrial Average is looking quite a bit better here all of a sudden. I talked about that on Tuesday as well, where you're seeing things like JP Morgan and Goldman Sachs do pretty well from the financials perspective that kicked us off with the earnings season. But in addition to that, today we just got done talking about, some of those bigger companies like IBM and, other blue chips that are kind of pulling their weight maybe a little bit more there. Now, it was still down today, so I don't want to make it a big deal out of it, but it was only down 0.3%, which was better than these other indices, right? The S&P 500 was down 0.8%. NASDAQ was down 0.61%, and the Russell 2000 was down 1.24%. So the Dow was once again the leader. And, I mentioned this, either Tuesday or last week. Sometimes the days get jumbled in my head. But we've been talking about how the Dow has, assumed a leadership role here all of the sudden. And we knew that as far back as this, engulfing candle over here on the 13th. And that was exactly 1 week ago when I was with you. And I was mentioning during that video that, the Dow was closer to the moving average, and therefore all else being equal, it's going to be the one that has the greatest chance of getting above the moving average and staying above it. And that's what I really want to see if we are to have a bullish trend change. So far, so good on that count. Yes, we've been down 2 days in a row on the Dow, but what has also happened is we've stayed above the moving average for 3 days in a row now. So, I think I mentioned to you guys this on Tuesday where I was talking about both the Dow and the Russell 2000 were more impressive to me than the S&P 500 and the NASDAQ, but I gave the favor to the Dow, and this is nice how it plays itself out perfectly here for me to have this educational conversation with you because really this would have been textbook. Now, of course, I wouldn't have known 2 days ago what was going to happen in the market, but this is a perfect example of what I was referencing on Tuesday, which is, when you get a big enough pop above the moving average, then you've got a little bit more wiggle room to give some back and still stay bullish. And the Dow had that wiggle room because you had that nice gap up there on Tuesday, and you really didn't have a big sell-off in the last 2 days, so you were able to stay above the moving average. With The Russell 2000, remember we were joking that it must have been only just a couple of pennies above the moving average. We knew that it was because the moving average color changed to yellow, but we could barely see it. So that meant that it was just barely, like by only a couple pennies above the moving average. In other words, there was no wiggle room there. So when the Russell 2000 is sold off the last couple of days, you don't have that luxury of having the wiggle room and keeping you above the moving average. Here, this is almost looking more bearish all of a sudden, right? This is looking like a bearish setup on the Russell 2000. And so, I will reiterate what I mentioned on Tuesday, which is if you are looking for bullishness in this market right now, to my eye, it still seems like it's the Dow Jones Industrial Average, the big blue chip companies that are providing that leadership. And I'll say the same thing as I said on Tuesday, which is, unfortunately, that's not what we want to see, right? We want to see the more speculative areas leading the way. We don't want to see the big blue chip companies leading the way because those are oftentimes viewed as defensive, and therefore it's a sign that the market is not really willing to embrace risk to the degree that you might want if you want to be bullish in these markets. So I would say that, judging by what we see on all four of these charts right now, there's probably a better chance that these other three charts that have their bearish postures right now pull the Dow Jones back into their vicinity than to have the opposite where the Dow just pulls the entire market up. But we could be wrong, right? And that's the nature of markets. There's always things changing. If Jerome Powell came out tomorrow and said, you know what, we went too far, we're going to halt our interest rate hiking campaign, markets would just, blow up to the upside in all likelihood, right? So you just don't know when a day like that is going to come around. Now, I don't foresee a day like that happening anytime soon. Many, many months, if not a year or two from now before we see something like that. But you just never know, right? I don't work for the Fed, so I have no idea what they're talking about behind closed doors, and you have to account for the variability of the markets based upon news that is hitting it. So we have to be prepared either way. Right now, to my eye, it seems like the NASDAQ is the laggard and the Dow Jones is the leader. So if we do have bullish movement moving forward, then the Dow seems to be the place where you could be looking for opportunity. If we continue to have more bearishness into the winter, then the NASDAQ composite will probably provide that opportunity for you. Okay, so in terms of other things to be aware of, the NASDAQ is not quite into the lower reversal zone again, but it's the one with the smallest intermediate reading right now at 24. And so that is lagging the 28 intermediate reading on the S&P 500 and the 29 intermediate reading there on the Russell 2000. So all three of them, if we get another big sell-off tomorrow, could theoretically find themselves back into the lower reversal zone before we know it. So we'll have to keep our eye on that situation there. Remember on Tuesday I was with you, the NASDAQ was the only one that did not have a weekly bullish posture. But I said, be on the lookout for the next day where there is a pretty high likelihood that it would turn weekly bullish. In fact, I wrote that up in the paragraph. Some of you might not be aware if you only watch this on YouTube, but we also write up a couple of paragraphs of information associated with these videos for our website. So if you're watching the video on our marketscholars.com website, above the video, you'll see our commentary for that day. And one of the things I mentioned there is that the NASDAQ would likely go to a weekly bullish posture the next day, and it did. The problem is it didn't do it with a whole lot of enthusiasm. It was a whimper, and that's why here we are just one day later back to a strongly bearish posture. So until we get above those moving averages and stay above them, I'm not going to trust the postures that are going to be ever fleeting with the intermediate line. If we can get more of this behavior like we see with the Dow Jones Industrial Average, then we're talking. Now we've got something to build upon. But even that is going to be a challenge given the terrible sentiment that we have on Wall Street right now. And of course, as I mentioned before, tomorrow we could very well be in the hole as we kick things off as a result of those Snap earnings results that came out. All right, so I think that's what I wanted to spend some time on there. 3 out of the 4 back to strongly bearish postures. The only exception there is the Dow Jones Industrial Average, and even there, it could very well flip back to a bearish posture here relatively soon if it gets back below its moving average. Keep in mind, tomorrow's an important day. Tomorrow is options expiration day, triple witching there for the October contracts, and so hopefully it doesn't get too squirrely, too ghoulish, too much Halloweeny, going into the triple witching there, and hopefully markets behave themselves, because we've seen some pretty chaotic Fridays here more recently, and we're kind of setting up for that sort of behavior once again. Let's step away here and pop on over to the internet. I always like to get a chance to say thank you to those of you that help support this Market Outlook presentation. It takes about 3 hours minimum to do these videos and prep and writing up the paragraphs and doing the editing and processing and yada, yada, yada. There's an endless to-do list when we do these. And we basically don't make any money. We tried to do a little advertising here or there lately, but it's a pittance compared to what our time is worth. And so we'll see if that ever takes us to a different place in the future. But I say that because we have to regularly ask ourselves whether our time is well spent when we burn up 3 hours out of our day to do these free videos for you guys on YouTube. And so the one thing that I ask you to do in order for you to send me the message that you think that these free videos are worthwhile to you is simply take 5 seconds out of your day to click like for me there on Twitter. I'm not asking you to pay me a cent. I'm just asking you to take 5 seconds out of your day. In other words, you trade your 5 seconds for my 3 hours. And if you think that's a pretty good trade-off, then I would encourage you to do that each time David and I are doing the video. Thank you to the 104 of you that did this last time around. As I mentioned before, we actually had some processing challenges with YouTube on Tuesday night that I was not anticipating ahead of time, which I had to chuckle about after the fact, because I was actually talking about how as long as technology is holding up its end of the bargain in that video, wouldn't you know, the technology gods must have been listening and wanted to have a good laugh at me. And so we had a little bit more of a delay there, so we didn't have as many likes as I normally would have, because there would have been other people that would have watched the video during that first 4 or 5 hours. Many of you know that I try to get this video done by about 5 or 6 my time out here in the Mountain Time Zone, which is usually about 7 or 8 East Coast time. So that way you guys on the East Coast can watch my videos before you go to bed that night. So I try hard to stay to that schedule for you guys. And if you appreciate the effort that goes into that, then that's another reason why you might be interested in clicking like. Not to make you feel bad or anything, but I usually end up missing dinner with my family as well, right? And so I have to sacrifice like a lot of business owners do. And I sacrifice for you for a free video. And I know not all of you would want me to do that, because many of you, of course, are good family people as well. But not saying that to get your sympathy or anything along those lines, but just a reminder that yes, we all have to make sacrifices, and if you appreciate my sacrifice on these videos, then it should not be much of a sacrifice at all for you to click like for me. So let's do some shout outs here. I appreciate Greg and Paul and Brandon and Michaela, Stacy, Tammy, Adrian, Evan, Aviva, Duda, George, Robert, Nietzsche, Arth, Trunk, Dave, we've got Jim and Tom and Fun Jonesy and Sheila and Ron, Camilla, Sigaran, Irene, Barry, and others. Can't get to all of you, but I do appreciate each and every one of you. Thank you very much. Please keep that up if you enjoy these videos. Also, while we're over here, reminder that I did my question and answer session earlier today. So if you're looking for additional content over the weekend and you're a premium member, feel free to check that out. Lots of great questions as always. And then David taught his portfolio management with ETFs class earlier today, and he does a fantastic job with that class as well, so check that out. And then tomorrow he'll be teaching his technical analysis class, so if you've got that time in the late morning, feel free to join him if you're a premium member of Market Scholars. Let's have a chat here about the factor selector tool. And this is put together on Tuesday night, so I like to remind folks it's a couple days stale by this point, but at least can give us a general idea as to what's happening from a factor perspective as the weeks roll along. And for the third straight week, we had momentum perched up there at the top. Momentum is getting the benefit of having a lot of oil and gas stocks within its ETFs at this moment in time, because it's been one of the few areas that has been working reasonably well over the past year. Remember, a lot of those momentum factor ETFs have specific rules in their prospectus that they rotate based upon 1 year strength or something along those lines. And since the vast majority of stocks have done terribly over the past year, except for the energy companies, and that means that they are going to make up a much bigger chunk of those than they would otherwise. And so I think that's kind of the story in that particular case. We did see that the more mundane areas that benefit when markets are a little sketchy, low volatility, dividend yield, and value either held their own in the case of dividend yield or rose in the case of value and low volatility. And that conversation is the same that I just had with you a second ago around the Dow Jones Industrial Average, and how we don't necessarily want that, right? That is a sign that risk appetite is not particularly high. We did find that quality fell down to the bottom. Now, those of you that attend my factor-based swing trading class on Wednesday mornings will not be surprised to hear this, but for those of you that just watch our free YouTube video, be aware that quality is not your grandfather's quality. Quality 10, 20, 30 years ago would have meant a different thing than what quality means today, and that's because technology has taken over the world. You know, that phrase, software has eaten the world, it rings true in this case. If you look under the hood of many quality ETFs, they are chocked full of companies like Apple and Microsoft, which are tech companies, and therefore when tech companies from a sector perspective are out of favor, then there's a pretty decent chance in this current era that the quality factor ETFs will be out of favor as well. And typically what happens is when we are in more of a risk-off market environment, market participants sell off the technology sector because it perceives it to be, a little spicier than something like utilities or something like that. And so from my perspective, that's kind of what we're seeing there with quality, is it's kind of being unfairly punished because it's so closely aligned with the technology sector these days. All right, let's go ahead and pop back on over here to the main part of the platform and do some 12 grid analysis. And let's go ahead and get started here with chart 5A. And so on 5A, you can see here we've got a nice mixed group of, pink and green charts. Remember, on these miniature 12 grid charts, the green colors mean that the current posture is bullish. The pink background colors mean that the current posture is bearish. And then there's two different shadings for each of those colors as well to signify either weak versus strong posture. So let's talk it through. Unfortunately, we have the same old lighting up on the bottom rung that we've been talking about all year. In the lower left, I kind of feel like I'm announcing a heavyweight fight here. And in this corner, we have the US dollar coming in at $30.37. And it's going to be battling today the 10-year U.S. Treasury yield, coming in at $42.26. That would be one heck of a heavyweight battle, wouldn't it? Those two have just been crushing it this year. And unfortunately, what that means in kind is that we in the stock market have been getting crushed, because we in the stock market traditionally don't want those two things to be bullish. So that's bad news for most of us. But it is what it is. And there are certainly opportunities that emerge, especially if you want to be bearish, right? But the US dollar is back to those strongly bullish postures here all of the sudden. Remember, on Tuesday, I was mentioning that it had a weekly bearish posture, but it's the same conversation that I mentioned with the overall indices, which is I didn't really trust that bearish posture. Yes, I acknowledged it because it was down 3 out of the 4 days, but it was not yet trading below its rising 30-day moving average. And so here we are 2 days later, and naturally we have now flipped back to a strongly bullish posture where it probably deserves to be, because the dollar has just been red hot this year. And then on the flip side, speaking of red hot, holy mackerel, when is this going to end? I mean, this is like death spiral time period for the long bond. And you can see the corresponding rise in interest rates over here. So we are at 4.22% on the 10-year right now. And some of the shorter term maturities are even more aggressive than that, up there near like 4.5%, 4.6%. It is insane. And this is all happening basically within like 3 weeks, at least a majority of the move, where it just kind of almost feels like one of those kind of weird parabolic moves that takes place with like a growth stock, something like a GameStop or something like that. But this is happening with, billions, if not trillions of dollars, at the surface there. Because remember, the Treasury market is absolutely massive, which exaggerates this situation even more. For some of you might look at this chart and say, well, what's the big deal? It is absolutely extraordinary. If I were to right click on this TNX chart here, this is the 10-year Treasury yield, and then go back let's just go back 3 years. Take a look at where we've come from in 3 years. Right here in 2020, we were at, it doesn't show the price unfortunately here, but let me actually do this for this part of the conversation. I'll come over here to the swing trading chart so we can see the actual price. I think that kind of leaves an impact a little bit more than percentage, especially when we're talking about yield. You usually don't talk about yield in terms of percentage up or down. You usually talk about it in terms of basis points. But anyway, coming back over here and looking at a 3-year chart on the TNX, and notice back here in March of 2020, we were down below 0.4. Okay, so because remember, on TNX you move that decimal point over to the left once. On the Thinkorswim platform to read that properly. So we went from 0.4 to above 4.0 in less than 3 years. And it looks like it knows no bound. I mean, this thing just rocketed here at the end of the session today. It was like every hour you look at it and it's higher than it was before. Here's something else that is just unreal. Take a look at how many of these candles in a row are positive candles. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. That's 12 straight trading days where the TNX is higher. Interest rates have climbed for 12 trading days in a row. Remember, that's not calendar days. So we're basically saying for 3 straight weeks, we have not seen a single tick lower in interest rates, at least on these kind of mid to longer term interest rates. So it's remarkable, and you don't see this very regularly. This has basically been the worst year in history for a lot of different bonds that are out there, and so that's what's made 2022 so unique, is that not only does it feel like the sky is falling for equity traders, that happens every so often, but to have it happen in the exact same year when it feels like the sky is falling for bonds, because remember, the opposite of this is what's going on with TLT, which is a bond ETF. In fact, today in my Q&A class, if I had to describe what the theme of the class was, which I'll never know going into it because that Q&A class is a little bit more open-ended. David and I each teach our 4 trading rooms, which have a specific, kind of approach. Think of it like a professor giving a lecture where they have everything prepared in advance of what they want to talk about. about and how they want to take the trades and all this kind of stuff. Our Q&A sessions that we teach, I teach mine Thursday morning, David's is on Saturday mornings. That's an opportunity for our premium members to work directly with David and I and basically ask us whatever they want, as long as we have some sort of a background knowledge to help them answer the question. And so we had a lot of questions today about fixed income, about treasuries, about bonds in general. And so it seems to be a hot topic right now, and for good reason. When you see markets moving as aggressively as this, it is very, very rare. And so, it's just been a one-way train wreck to the downside for bonds this year. Almost on a impactful basis, it's almost been worse for bond investors than it has been for stock investors, believe it or not. I know a lot of us stock investors are going through our own pain right now, but bond investors are not used to that kind of pain. At least stock investors are like, yeah, you remember what it was like in 08, 09? Heck, even at the end of 2018, in the COVID wipeout, we were down 35%. Back during the dot-com bubble, I know not all of you were trading back then like David and I were, but we've had a few of those skirmishes in recent decades where stock investors kind of understand, yeah, that happens. But for bond investors, they're like, what in the heck? Where did this come from? I'm not used to this at all, because the last time we've had a situation like this has literally been decades ago. So it's aggressive selling that's taking place out there in the bond market, and it makes you wonder, where do we go from here? And it seems like Jerome Powell holds the keys. How hawkish does he want to be moving forward? So really chaotic trading with fixed income and with yields right now. Let's go back over here to our 12 grid, talk through some of our other postures now. So again, the two lower corners on the charts are back to that dark green, which we don't want to see if we want to be bullish in the stock market. In terms of other green charts, we do have foreign developed stocks and then also high yield bonds that have maintained their light green background colors, telling us that we have weekly bullish postures. But then again, that's one of those situations where I would say I'm not going to trust it until I see more evidence, because again, we're below a falling 30-day moving average in both of those cases. So it's great that the one technical indicator is suggesting there's some little bits of bullishness entering the system. Until we get more evidence, I'm just not going to have the confidence to take a really robust bullish trade on them. Maybe if you want to be speculative or what have you, go ahead and be my guest. But I would say tread cautiously there, given what we've seen so far in 2022, which is usually you should not trust a weekly bullish chart or a weekly bullish posture that is associated with a stock or an ETF that's trading below its falling 30-day moving average. You shouldn't trust that any more than you can throw it, because more times than not, you end up on the disappointed side of the equation there. So we'll see. Maybe they can prove me wrong. Maybe they can get back above their moving averages, but right now it's kind of looking like bounces down and away from their moving averages. All the rest of the charts on the board are pink, and the only one that's light pink is oil. And that one did have kind of an interesting thing to point out. It did have its moving average change back to green today, which means, as I told you before, price is above a rising moving average now. But before we get too excited about that, I'll remind you that we had a green moving average back here for about 4 or 5 days, and eventually it went back in the direction in which it came, which is downward trending. We also had a good conversation in my Q&A class today about natural gas prices and commodities in general, and what are some of the things that are affecting those prices. So feel free to check that out if you're interested. I think it was the very first question I answered today. But oil is, I guess, doing better than some of the others, but that's not really saying much. So let's not take that concept too far. Notice that gold has been falling out of bed once again, has the dark pink color telling us we've got strongly bearish posture. In fact, it's so bad that it might turn good. And what I mean by that is today we did get an oversold cluster signal. However, keep in mind, sometimes you can get clusters of clusters. And over here, we got several clusters. And if you had done something bullish on that very first one, you probably were not too enthusiastic about it unless you were lucky enough to get out as you had that reversion to the mean move right there. So, sometimes that will happen as well, where, yeah, you've got a cluster, but what gives you the confidence that that will be a single cluster that you can take action on at this moment in time? what we can say here with gold is it appears that it's either at that 3-month low or maybe it even breached it. Let me right click and maximize it so we can see it a little bit closer here. It looks like it is still, at least on a closing basis, slightly higher than where it was here on September 26th. But one more bad day tomorrow, and you could be back into that mode of lower highs and lower lows. And my friends, that's a downtrend by definition. And so be cautious, taking bullish trades on stocks that are clearly in downtrends. So we'll see if maybe they can either bail out the bulls by forming a double bottom starting tomorrow or break through that candle and confirming that this is a continued bearish downward trend here for gold. Obviously, downward trends on long-term U.S. Treasuries, on foreign bonds as well. And then Bitcoin had a fleeting moment here earlier this week where it went back to weekly bullish, but that didn't last long. Here we are back to strongly bearish once again, and it just seems like it really can't do much of anything right here recently. One thing I would say about it is it has stopped falling. It's just that it hasn't started rising. We're kind of in limbo right now on Bitcoin, but you probably want to lean a little bit more bearish given the sentiment of the overall market and the risk appetite out there, in addition to it still being below its falling 30-day moving average. But it is a little bit of a different looking chart than gold. Like the gold chart right now looks worse than Bitcoin because gold appears like it's likely going to have a continuation of its downtrend. Whereas Bitcoin, you could get away with saying it's trying to hold levels. And while the odds of it doing so successfully are probably not great, at least there's that hope there. The prospect exists, because really Bitcoin is still trading above where it was back here at the beginning of September. And, not all risk-on assets can make that same claim. Notice that preferred stocks are also heading lower. Remember, preferred stocks oftentimes act like bonds, and so that's not a huge surprise there with interest rates surging. And then emerging markets continue to be with a strongly bearish posture, although they were up nicely today. And I did notice that, a few of those Chinese names, Alibaba and what have you, were up. So not sure if there was, some positive news out of China or what, but that's really not, helping you all that much when you're looking at this downtrend and you're up a whopping, 0.64% here today. So it's going to have to do a lot more work than that to get us excited about it to the long side of the equation. Remarkably, EFA is holding on to that weekly bullish posture right now from the developed foreign stock world. But as I mentioned before, I'd be a little bit cautious trusting that right now until we break up above that moving average and ideally break up above that candle on October 4th. If we can do that and stay above the moving average for a few weeks, then hey, we're in business. But until then, you kind of have to trust that the trend is going to exist until it gets broken. And right now, we have not broken trend. All right, let's go ahead and take a look at our sector analysis now. And as we're pulling this up here, I wanted to focus first of all on discretionary because I hadn't even looked at this yet, but I was curious how Tesla would impact its day. I figured it would be one of the worst performers out there, and it's amongst them, but interestingly enough, it's not the worst one. Utilities was actually the worst one, and I'll actually have something to say about that a little bit later on in our trade application example. So utilities were the worst performer today, and then industrials and discretionary were basically tied for second worst at about 1.9% to the downside. So again, discretionary is driven in this case with XLY primarily by Amazon, Tesla, and Home Depot. Those three are way more influential than pretty much anything else in that particular ETF. In fact, those three are probably more influential than the bottom half of all the rest of the stocks that are in the discretionary sector. That's how dramatic the market cap differences are within that particular sector. So not a surprise to see discretionary down pretty good amount today based upon what we saw out of Tesla earlier. Industrials, that's a little bit of a disappointment, I must say, because On Tuesday, I was trying to get a little bit more optimistic about industrials as it popped its head above the moving average, and that wasn't something we had seen a lot. But after the last 2 days, now I've got to temper my enthusiasm once again because it kind of looks like it's rolling back down underneath its falling 30-day moving average. So, you want to see a continuation of that bullish move, and we did not see that at all. We're seeing a reversal of it instead. So not a great view there out of industrials, despite having some of those defense companies like Northrop Grumman and some of those that I had mentioned before being up. It just couldn't stop the bleeding in the rest of the sector with, other stocks like GE and Caterpillar and those types of industrial names. So they struggled here today as a risk-off sector. And utilities struggled today because of interest rate sensitivity, right? Utilities and REITs typically most interest rate sensitive. So when we have a big up move in interest rates like we did today, in fact, we've had for 12 days in a row or whatever it's been, then you're going to see that utilities will really struggle in that type of a market environment. In terms of who the best performers were today, we actually did have 3 different sectors that closed in the green. And wouldn't you know, they're the 3 that actually have the bullish intermediate postures as well. So XLC was up 0.24%. Kiss that goodbye, because as soon as tomorrow morning, that's probably going to be back to some more selling as a result of what we're seeing with Snap and Meta and Alphabet after hours. But for at least this moment in time, they managed to close up at the end of the trading session today before we gained that knowledge in the after hours session. Technology was up today, but again, just barely, up 0.06%. Both of those are still below their falling 30-day moving averages. So notice the moving averages are red. So again, that would be those types of charts that I would express caution to you guys with and say, yes, they are showing us weekly bullish postures, but until we can actually get above the moving averages, I'm not going to trust that posture. And tomorrow we'll probably find out why that is usually a good idea in this market environment to not necessarily trust that situation, because as I mentioned, communications is going to have a very good chance of having a bad day tomorrow. Whether it closes bad, I don't know, but there's a good chance that it's going to at least open bad, and has a worse chance to close above that moving average if we start off on the wrong foot. Energy is the outlier, right? Energy is actually a dark green background color, telling us that we have a strongly bullish posture, and it was up 0.09%. But notice it also has a green moving average, meaning price is above a rising moving average. Not only that, but notice that we did break through this resistance here from back at the end of August within the last 24 hours here as well. So that's another good sign that our leadership group from a sector perspective right now remains energy. And of course, we learned that on Tuesday as it was perched at the top of the sector selector tool as well. All right, let's talk about our trade application example. And I'm going to pull up our dividend stair-step chart here. And I'm going to pull up an ETF, XLU. And the reason I'm pulling this up is we were down 1% with a half an hour left in trading today. And many of you know when we're down more than 1%, I like to do sold put trades on dividend growth stocks traditionally. Obviously, XLU is an ETF, so it's a little bit of a different conversation here today. But as I was looking for stocks to sell puts on, many of them were utility stocks. And stocks like ATO popped up on my radar. ATO is a dividend aristocrat that has an oversold weekly cluster here and is not yet in the blue zone where we want to buy it outright, but maybe selling a put into that blue zone could make some sense. Other stocks that had a similar type of a situation, CMS, as you can see, also in that kind of neutral white zone of the dividend stair-step chart and an oversold weekly cluster. That's what those little green dots mean right there. I think there were even companies like Duke, I think also had a similar situation. Now, Duke did not close with the cluster, but earlier in the session it had one. So not only did the market bounce a little bit into the close, where we only closed lower by 0.84% as opposed to the 1% a half an hour before the market, but also Duke did. They got off their lows of the session as well, and therefore the weekly cluster disappeared there. But the point is, once I started seeing that many of these individual utilities had these weekly oversold clusters, I decided to pull up ticker symbol XLU, which is an ETF that tracks utilities, and wouldn't you know, it also has a fairly rare oversold weekly cluster here. And as you can see, when you go back on the chart, we had an oversold cluster right there, we had an oversold cluster right there, and we had an oversold cluster right there. So basically in 10 years before this moment in time right now, we had only 3 other instances of oversold weekly clusters for XLU. It is not a product that traditionally gets oversold. Obviously, utilities are usually thought of as the most boring area of the market. The more boring you are as an entity, the greater the chance is that you're not going to have an extreme enough sell-off to actually produce an oversold cluster signal. So this is somewhat rare to see this exist on this ETF that tracks dozens of individual utility companies. Now, naturally, it's down so aggressively here in the last month because interest rates have been shooting through the roof. And so, there's always the possibility that could continue, but there's also the possibility that that needs to cool off to a degree as well. And so you'll notice back here, if you had sold a put on XLU after this oversold cluster, it went sideways. When you're selling puts and the stock goes sideways, you make money. Over here, if you had sold a put when it gave us the weekly cluster, it went up. If you're selling puts when it goes up, you make money. Over here, if you had sold a put a month later or thereabouts, it went sideways, and you make money on a sold put when it goes sideways. What you don't want is for the stock or the ETF in question to continue to go down at an aggressive clip. That's where you can lose money. So we have all 3 of our prior instances suggesting that by selling a put at those rare times where this boring product gets extremely oversold, it would have resulted in profits. Now, were we dealing with interest rates that were going straight up in those other 3 instances? No. So, it's never going to happen in a vacuum. But if you were waiting for a moment to try to, do something a little bit more bullish on utilities, and you were smart enough not to buy them when they were breaking out up here, you're now wise enough to consider something bullish as their valuations are more attractive down here. So what I did was I sold the December $53 puts, and I think we got like 54 cents for them because I usually target about a 1% return on risk. And so, that was the trade that we did. Remember, I always do them before the market closes, and I send out the alerts via our private Telegram channel. So that way all of you who are premium members get access to our trade ideas before everybody else who watches the free YouTube video later that night. You also get benefit of seeing any of our trade management decisions. And tomorrow I'll probably have to make some trade management decisions on some of our October contracts. I've been doing some rolling with other sold put trades leading up to this week, but there's a couple more things I need to take care of tomorrow. So stay tuned to Telegram if you're a premium member. And if you're not a premium member, again, next month is our Black Friday sale. So what are you waiting for? Jump on in. The water's warm. All right, that'll do it for the night. Hope you guys enjoy your rest of your evening. Looks like we've got a good game tonight on Thursday Night Football with the Saints and the Cardinals. David will be back with you tomorrow or this weekend at some point. And then I'll be back in action for those of you that are premium members first thing Monday morning with top-down trend trading. So until next time, I want to wish you all the best of success with your trades and your investments. Goodbye for now.